Today, we are doing a deep dive into a fundamental, almost seismic shift in the PLAZM protocol. We're going to look at how the supply dynamics, the very math of the system, have been completely rewritten in just a handful of weeks. So let's get right into it. But first, you know the drill, we got to get this out of the way. This is all for educational purposes. This is absolutely not financial advice. Please always do your own homework before making any moves.
The entire story we're talking about today, it really all comes down to this one number, 73%. And trust me, this isn't just some random statistic. It represents a whole new reality for PLAZM, where the vast majority of its supply is now locked down, playing by a totally different set of rules. And this slide right here, it just paints the perfect picture of that new reality. As of day 104, a massive 73% of all PLAZM tokens are now what we're calling protected. That means they are just not available to create instant sell pressure. It leaves only 27% as truly liquid and tradable. I mean, this 73-27 split is a huge deal. It's a complete 180 from how the protocol used to be balanced. So here's our game plan. We'll start with this new 73-27 reality. Then we'll unpack the wild 20-day supply shock that got us here. After that, we'll look at the 3 layers of protection, the smaller float effect, and ask if this is sustainable, before we wrap it all up with our majority protected thesis.
So this new reality, what does it actually mean? Well, we're talking about a fundamental change in the protocol's DNA. It's gone from a pretty balanced system to one where long-term commitment is now, without a doubt, the dominant force.
Okay, now this is where it gets really interesting, looking at how that 73% is actually built. It's not just one thing. You've got 36% of the total supply. That's almost 2 million tokens staked and locked up tight. Then there's another 25%, or 1.37 million tokens, committed to providing liquidity. And get this, a final 12%, over 650,000 tokens have been burned. They're gone, just poof, permanently destroyed. All of that leaves just that little 27%, or 1.52 million tokens, as the liquid, tradable supply.
Now, this whole transformation, it didn't exactly happen overnight, but man, it was incredibly fast. In just 20 days, the protocol went through this massive supply shock that pretty much rewrote its own rulebook.
Just look at this timeline. 20 days ago, on day 84, things were perfectly balanced, 50-50, protected and liquid. Fast forward to day 102, and that balance is already gone. Protected supply hit 63%. But then, bam! In just the next 2 days, it explodes to 73%. A massive, massive shift in an incredibly short amount of time.
Seriously, just let that sink in for a moment. The jump in protected supply in just 2 days was 10 full percentage points. That's almost as much growth as we saw in the entire 18 days before that. This incredible acceleration, mostly driven by a huge surge in liquidity providing, really signals a major change in how people are thinking about the protocol.
To really get what this 73% means, we have to break down what each of these layers of protection actually is. Because, you see, they're not all the same, and their differences are really key to the whole story.
Okay, this table lays it out perfectly. First, you have the burned supply at 12%. That's the ultimate protection, right? Those tokens are gone forever. Then you've got the 36% that's staked. That's locked for over 2 months, which shows a serious commitment. And finally, the 25% in liquidity pools. We call this sticky supply because people are incentivized to keep it there to earn fees. It doesn't tend to move much. Each layer plays its own part in this new dynamic.
All right, this brings us to what's probably the most important concept here, the smaller float effect. When you have so much supply locked up, the math for the tokens that are left, it just completely changes.
Think about it like this. Imagine $10,000 of sell pressure hits the market. Back when half the supply was liquid, that pressure was spread out over about 2 million tokens. Well, today, with only 27% liquid, that same $10,000 is now absorbed by just 1.5 million tokens. That's 26% less supply soaking up the exact same pressure. And of course, the same logic works for buying. Any new demand is now fighting over a much, much smaller pool of available tokens. The effect is magnified, both ways. And this surge in protection had another huge benefit, way deeper liquidity. The amount of PLAZM in the LP pool shot up by 60%, from around 858,000 tokens to 1.37 million. What that means is larger trades can happen with way less slippage, and it creates a much stronger structural floor for the price. It's a trade-off, really. Tokens moved from the can-sell pile to the protocol infrastructure pile.
So,
we know that at most, 27% of the supply could theoretically be sold. But is that realistic? I mean, is every single person holding a liquid token just waiting to hit the sell button right now?
Of course not, right? That 27% number, that's the maximum possible sell pressure. It's the worst-case scenario. The realistic, day-to-day sell pressure is only going to be a fraction of that. A lot of those holders are accumulating, or they're just waiting for different prices. A much more realistic guess for immediate sell pressure is probably closer to 15, maybe 20% of the total supply, not the full 27%.
And that leads us to the most important question of all. Is this new, highly protected state actually durable? Can this 73% level hold up over time, or is this just a lucky snapshot?
Well, when you actually analyze the different parts, the outlook seems pretty strong. The burn supply is permanent, and it can only go up. Staking is renewable, which means as old stakes unlock, the system relies on continued belief to create new ones. And the LP, as we said, is usually sticky because of the fee incentives. So yeah, the mechanisms are definitely in place to support a high, durable level of protection.
Okay, let's bring it all home. Let's pull all these data points together. What is the final thesis here? What does all of this mean for the identity and the future of the PLAZM protocol?
Here's the bottom line. PLAZM is now a majority-protected protocol. The number of tokens available for trading has been squeezed hard, which dramatically reduces potential sell pressure. The protocol is no longer being driven by short-term traders, but by its most committed long-term believers. It's a different game now.
73% protected, 27% liquid. The math has changed. The dynamics have changed. When nearly 3/4 of your supply cannot create immediate sell pressure, the protocol just operates differently. This isn't just a milestone. It's a new reality. Day 104 is the day PLAZM became a protocol of the committed.
And finally, just a quick reminder that markets are always on the move. Supply distributions can and will change. This analysis is just a snapshot in time, and past performance is never, ever a guarantee of what's to come. Thanks for watching.